Good afternoon. We'd like to welcome you to the Gabelli Funds live webcast series. Today, we're excited to be joined by Tim Winter, Associate Portfolio Manager of the Gabelli Utilities Fund, to discuss the current global era for utility stocks. Tim joined GDOT Research in April of 2009 and joined Mara Gabelli in May of 2018 as an Associate Portfolio Manager of the Gabelli Utilities Fund. He was recently recognized in 2018 Thomson Reuters U.S. Analyst Awards as the #1 ranked stock picker in the electric utility sector and water utility sector, and the #2 in the gas utility sector. Tim received his BA in economics from Rollins College and earned his MBA in finance from Notre Dame, and is also a CFA charter holder. I'd like to now turn the call over to Tim.
Thanks for those that are joining us to discuss the outlook for utility stocks, and as we highlight our Gabelli Utilities Fund. I titled the presentation The Utility Golden Era, where 5 to 7 is the new 3 to 4. I call it a golden era because the fundamentals of the group are as strong as ever. Utility stocks are growing earnings and dividends at a much higher rate than historically at 5 to 7%, which compares to the historical growth rate of 3 to 4. The sector is in the midst of an extended investment cycle, a super investment cycle, if you will, as it transforms into a cleaner, greener, and safer system and networks. The utility balance sheets and credit ratings are strong, which allows for low cost of capital to fund the heavy investment cycle. The public and politicians are supportive of the investment, as most feel it's imperative to save the climate. Regulators are allowing workers that encourage investment, and this leads to earnings growth. Finally, the industry continues to consolidate where small and mid-cap utilities could be purchased at premium prices. Not only are the fundamentals strong, but the timing appears right. Utility stocks offer a safe haven in a world of volatility and geopolitical risk. The sector has little, if any, exposure to the global trade war or a Middle East oil war or even a congressional impeachment war. Business risk is low. As you know, utilities are monopolies. They serve necessary products, water, electricity, and gas. And finally, they're becoming ever more ESG friendly. Many utilities are showing up on favorite lists for making the greatest improvements in environmental quality and carbon reductions. These defensive growth characteristics are especially important as the U.S. Treasury curve has lowered, flattened, and even inverted. An inversion historically signals a recession or a slowdown, which would bode well for the defensive utility sector. The 30-year and 10-year Treasuries have declined. They're now below 1.8% for the 10-year and 2.2% for the 30-year, which compares to their year-end levels of 2.7 and 3%. Many feel the Fed will continue to lower the Fed funds rate in the future. The 3% current return or yield on utility stocks is attractive relative to these low Treasury returns. Plus, utilities grow dividends on an annual basis. In 2018, over 90% of our utility universe grew the dividend at a median rate of 6%. And as we mentioned, we expect the dividends to grow at 5 to 7% going forward. The strong fundamentals have led to strong stock performance. Year to date, the S&P utility sector has returned over 23%. Over the past 5 years, 79%, which has outperformed the S&P 500. I'd like to point out that even in the 3.5-year period that saw the Fed raise the Fed funds rate 9 times, utilities outperformed with a nearly a 62% total return. The major driver of the strong fundamentals is the super investment cycle that I'm talking about. The sector has experienced 7 consecutive years of record capital investment, and this is likely to continue for the foreseeable future. If you look at the bar chart, you'll see that there's a little bit of a decline in 19, and that's simply because utilities update their capital expenditure budgets with visibility. That's likely to be much higher and higher going forward. Many states and utilities have targeted 2050 to be carbon neutral with phased-in targets along the way. And utilities grow earnings by investing in rate base, and then they go to the regulator and ask for a fair return. The more they invest, the more they can earn. The higher capital investment is primarily driven by this rapid transformation from clean and green to clean and green from a higher coal and nuclear base. If you look, the nation is quickly moving from a dependence on fossil fuels to a dependence on renewables. In addition to the CapEx that's being spent to retire coal and gas, battery storage is becoming a real thing. Grids are being modernized to handle two-way flows from rooftop solar, and electric vehicle charging stations are being added. Shale gas is in abundance and becoming a bigger part of the energy industry, so pipelines are being built, expanded, and replaced. Much of this investment is resulting in greater efficiency, which is lowering costs to the customer. So all this investment is being accomplished with little impact on customer bills. The public and politicians support the investment, and regulators are allowing returns. This all leads to earnings and dividend growth. As can be seen on slide 10, utility managements are confident in their growth outlooks, with many targeting 5 to 7% earnings growth, some even higher, with Avon Grid leading the way there at 8 to 10%. And again, this is much higher than the historical growth rate of 3 to 4%. We continue to emphasize here that utilities are not bond proxies, that they should be valued on earnings, cash flow, and balance sheets like any other stocks. We favor utility stocks that can grow earnings and dividends at above average growth rates. Take, for example, our largest holding, NextEra Energy. The company is based in Juno Beach, Florida, operates the nation's premier regulated utility franchise throughout the state of Florida, and also has a non-regulated subsidiary, NextEra Energy Resources. That's the nation's largest wind and solar developer. The company's grown earnings and dividends at a 7.3% and 9.7% rate over the past 10 years, which has led to a 466% total return over that 10-year period, significantly outperforming the S&P 500. Company continues to target 6 to 8% growth through 2022, as it's targeting 20% of the 80 gigawatts of renewable demand that's expected across the country by 2022. Another example, American Water Works, the nation's largest water utility, has an even more impressive earnings and dividend track record. Over the past 10 years, the company's grown earnings at an 11.3% rate and delivered a 686% total return. The utility targets 7 to 10% growth going forward, simply by upgrading aging infrastructure and consolidating the nation's smaller water and wastewater systems. Utility stocks also benefit from ongoing consolidation. Since 1990, the sector has experienced over 150 acquisition announcements and 120 completed deals. Buyers have ranged anywhere from neighboring utilities to private equity to multinational utilities to more recently Canadian utilities, which have bought 8 U.S. Utilities over the past 5 years. I also point out that Warren Buffett and Berkshire Energy have publicly stated a desire to be the largest utility in the nation. They've been a participant in consolidation. They've bought Pacific Corp, NV Energy. They bid on Constellation, and more recently on Oncor, which is the Texas distribution utility that was bought by Sempra. Since 2016, there have been 22 deals announced. We expect more going forward. Some examples that have helped the fund more recently include El Paso Electric. We owned 809,000 shares on June 3rd when the company announced it was being bought by private equity part of JP Morgan. Their stock is up 33% year to date as a result. Another example is Vectren, which was bought by CenterPoint in a deal that closed back in February of 2019. We owned 445,000 shares. So we expect utility stocks to continue to benefit from consolidation. I want to, on slide 15, just address a question we often get here about utilities and investors concerned that higher interest rates could lead to negative performance from utilities and therefore avoid utilities. We often hear this also from the media, that utilities are bond proxies. I want to emphasize that utilities are real stocks and not bond proxies. Bonds do not grow coupons. As I mentioned earlier, utilities are growing the dividends on an annual basis. Last year, 93% of the utilities in our universe raised the annual dividend by a median 6.1%. We're expecting 5 to 7% annual earnings and dividend growth going forward. So yes, they are sensitive to interest rates, as are all equities. The sensitivity is mitigated by earnings and dividend growth. Also, as I pointed out earlier, utilities did outperform during the 3.5-year cycle of Fed funds rate hikes. And as we go forward, it's important to emphasize the Fed has been very vigilant in fighting inflation since the late 1980s, and we expect this to continue. So to sum this all up, we consider it a good time to add utilities to portfolios given their defensive appeal in the current world of volatility, as well as their favorable outlook. It's a golden age for utility stocks as they transform from fossil-fired generators to more efficient, clean, green utilities. They offer not just a safe haven, but growth going forward. And I think slide 18 highlights our fund, the Gabelli Utilities Fund. One item I'd like to point out is that the board recently raised the annual distribution to 88 cents from 84 cents. So the fund will now pay 7 cents every month, and then in March, June, September, and December, 8 cents. The increase was driven by the board's increased confidence in the outlook for both the sector and the fund. So with that, if there are any questions, happy to talk utilities.
The first one here, Tim, comes from Mark in Chicago. We just wanted to see if you could comment on Global Water Resources, ticker GWRS.
Sure. That's a small water utility, water supply company out of Phoenix, Arizona. We do not own any of it in the fund. Arizona historically is a challenging regulatory environment for water utilities and for water supply going forward. We are keeping an eye on it. It is an interesting company, and we do very much like the water utility space.
Going off of that, there was a couple questions that came in regards to historically high valuations with regards to utilities, and if you expect that to continue kind of moving forward.
Sure. Yeah. The strong performance of the group over the last several periods, as we highlighted, has led to historically high valuations. The sector is trading at roughly 21 times forward earnings on an absolute basis. But when we adjust for interest rates, for the low level of treasuries, and for the higher growth outlook, the valuations not only look reasonable, but borderline attractive in many cases. So I think adjusted for rates and the outlook for the sector, it's reasonably valued. In our opinion.
Another question: is there any exposure to 5G infrastructure in the fund?
Right, and about almost 15% of the fund is in telecom and media, and we do have exposure there from our team of telecom analysts, for instance, Verizon and BCE, and a number of other telecom holdings have exposure to 5G. I am not the expert on telecom, so I would encourage us to maybe get back to you on some of those names.
There's a couple questions coming in regarding the slides. The slides will be available. You'll be prompted to download them after the call, as well as sign up for a replay to be sent once it's available. Another question we had: any political impacts of the 2020 election that you're keeping your eye on in regards to utility stocks?
Well, one of the things we're looking forward to, as the election moves forward and the campaigns move forward, is the whole concept of the Green Deal. And, as we highlighted here, one of the things driving utility earnings growth is the need to invest in renewables and carbon neutral type footprints going forward. So the more emphasis that we see on this, the greater the earnings growth potential of the sector is, and I think eventually we'll see a lot of companies with maybe pure play type companies in the green energy space that'll provide even more upside. But the whole campaign, I think, is going to be positive for the utility sector and for the green energy and environmental type of investments that need to be made.
Tim, do you have any outlook on Dominion Energy, particularly with some of the acquisitions they made over the last several years?
Right, Dominion Energy is one of the larger cap companies in the industry. They have a lot going on their plate with the acquisition of SCANA, which was building a big nuclear plant that had to be abandoned. So there are some political issues there, and they also just built a big LNG facility, Cove Point, that offers growth potential. We're looking at just modestly toward the bottom end of the 5 to 7% range growth for them. They're targeting 5%, and I think it's a quality, solid utility, and it's a holding of ours, not one of our larger holdings, and we think it'll be a decent holding going forward.
Another stock specific here on Duke Energy as well as First Energy Corp. Any comments on those two?
So Duke Energy, is sort of the poster child of the industry. They're looking at 4 to 6% growth as they try to transform. They do have heavy exposure to coal and nuclear, which they are, in this whole, part of the whole transformation. They came out and said they're going to be carbon neutral by 2050. And, again, this is similar to Dominion. It's a large cap, solid holding. We're exposed to it, but not overexposed to it. We see, some better opportunities elsewhere. First Energy is more of a turnaround story. They recently spun off their non-regulated generation in Ohio, and they're trying to reposition themselves as more of a traditional regulated utility. It's trading at a discount, and I think there probably is some nice opportunity there going forward. That is also a holding of ours, and we're looking at perhaps adding more if the growth outlook materializes.
Another question on the modernization of the electric grid and how the progression is coming along there.
Utilities are looking to invest as much as they can to modernize the grid. They want to improve safety, reliability, the two-way communications with the customer. There is a long way to go. We're still in the very early innings. In some states they're further ahead, like California and Hawaii, where they have to integrate more rooftop solar. But it's going to be a very interesting place to invest with a lot of capital going in there because of the communication and the two-way flows that are going to be necessary going forward.
Another question in regards to positioning for unexpected events like wildfires, hurricanes, and some of the issues that have arisen with PG&E recently.
We currently don't have any exposure to PG&E. One of the things that this fund a little bit different than some of the other utility funds is that it is more diversified. There are more. We do have more holdings, so we don't have as much exposure to any one particular stock. We're actually trying to pay attention to PG&E to see if there's going to be opportunity as they come out of bankruptcy. But yeah, it's important to us to stay diversified so we don't have any one stock that's going to cause too much harm to the fund. Our largest holding is NextEra, and that's at 5.9%.
All right, great. That looks like all the questions that have come through. Certainly, we'll follow up with anyone offline if there's any additional questions. We thank you and have a great afternoon. Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.